Super Microcomputer Inc., or SMCI as you'll see it on your screen, is currently trading at $31.68 as of 2:40 p.m. EST on Thursday, March 5, 2026. We are seeing an intraday move of minus 2.97%, a slide that has caught a lot of people off guard given the broader tech bounce we've seen earlier in the week. While the NASDAQ has been showing some signs of life, SMCI seems to be struggling to find its footing today, slipping from an open of $32.32 and hitting a session high of $33.51 before this afternoon's fade. This kind of volatility is almost a trademark for the stock at this point, but what's happening beneath the surface is where the real story lives. Most people look at a 3% drop and think the AI trade is cooling off, or perhaps the company is losing its edge. The common expectation is that Supermicro should be riding the coattails of the big chip makers indefinitely, but the reality is far more nuanced. We are witnessing a massive strategic pivot that the market is currently punishing because it looks messy on a spreadsheet. While you might see a falling stock price, the company is actually in the middle of a massive land grab, intentionally slashing its own profit margins to lock in the world's largest data centers before competitors can even get a foot in the door. They are essentially trading today's profits for tomorrow's dominance, and that is a pill that short-term traders find very hard to swallow. If you've been following the narrative around Nvidia stock or even Apple stock lately, you know the focus has shifted from can they build it to who can deploy it fastest. That's where Supermicro lives. But here's the insight most are missing. Supermicro isn't just a server box company anymore. They're moving into the liquid cooling and infrastructure space with their data center building block solutions. Think of it like the classic razor and blade model. They are selling the servers, the razors, at razor-thin margins right now to ensure that when these giant AI factories need the blades, which in this case are high-margin cooling systems and power units, they have no choice but to buy from Supermicro. Looking at the intraday action today, the volume is sitting around 19.7 million shares, which is a bit light compared to the 30-day average. This suggests that while the price is dropping, we aren't seeing a mass capitulation from institutional holders just yet. Instead, it feels like a period of consolidation and uncertainty. If you're using a platform like Robinhood or checking your individual brokerage account on a regular basis, these swings can feel gut-wrenching, but institutional activity shows a different picture. We've seen some heavyweights in the wealth management space, like those handling large Fidelity investments or Schwab Intelligent Portfolios, maintaining their positions. They aren't necessarily buying the dip with reckless abandon, but they aren't running for the exits either. They are waiting to see if the margin compression we saw in the last earnings report is a permanent scar or a temporary strategic bruise. Speaking of that earnings report, the reality versus expectation gap was massive. People expected Supermicro to print cash. Instead, they reported a record $12.7 billion in revenue, a 123% increase, but their gross margins plummeted to around 6.4%. That is why the stock is sitting in the $30 range instead of the $60 range. For a smart investor, this creates a curiosity loop. Why would a company growing revenue by triple digits see its stock price cut in half? The answer is that one single customer accounted for over 60% of that revenue. The market hates customer concentration because it creates a single point of failure. If that one big fish leaves, the whole house of cards could tumble. However, the contrarian take is that being the primary partner for the biggest AI build-out in human history is a moat, not a weakness. When you look at the landscape of online investing today, there's so much noise. Whether you're using the Robinhood app for quick trades or a more robust system like the Interactive Brokers platform, the data can be overwhelming. You see SMCI's 52-week high of $62.36 and look at today's $31.68 and wonder if the glory days are over. But consider the inventory. Supermicro is sitting on roughly $10.6 billion worth of inventory. In a normal hardware business, that's a red flag. It means products aren't moving. But in the world of AI, where there is a global shortage of high-end components, inventory is a war chest. They have the parts that everyone else is waiting for. This means they can fulfill orders for the upcoming NVIDIA Vera Rubin or AMD Helios platforms faster than almost anyone else. This brings us to the core of what Supermicro actually does. At its heart, they provide high-performance server solutions. They don't just put chips in boxes, they design the entire thermal and power architecture. Their business model is built on green computing, which is a fancy way of saying they make servers that don't melt while processing billions of parameters. They've been around since 1993, but they've pivoted hard into the AI data center space over the last few years. While past performance showed them as a steady mid-cap hardware play, the recent explosion in demand for AI compute has turned them into a lightning rod for volatility. For those of you managing your own portfolios through self-investing or seeking investment help from a robo-advisor like the SoFi robo-advisor, it's important to distinguish between a company's operational health and its stock price. Operationally, Supermicro is shipping more product than ever. They even outpaced Dell in AI server shipments last quarter. But the market is a weighing machine in the long run and a voting machine in the short run. Right now, the votes are coming in negative because of those shrinking margins. The weight is the $40 billion revenue target for the fiscal year 2026. If they hit that, the current valuation might look like a massive oversight by the bears. I want to pause here for a second and get your take on the current state of the tech sector. Comment below how many shares of Supermicro you currently hold, or if you've moved your capital into safer havens like Fidelity ETFs lately. I'm curious to see if the sentiment here matches the price action we're seeing on the screen today. The macroeconomic pressures aren't helping either. High interest rates have made the cost of carry for that $10 billion inventory very expensive. If they can't turn that inventory into sales quickly, the interest on their debt will start eating into what little profit they have left. This is why you see analysts from places like Goldman Sachs maintaining a sell rating with price targets as low as $26. They are worried about the cash burn. On the flip side, you have the bulls who point to the fact that liquid cooling becomes a requirement, not an option, for the next generation of chips. Supermicro is the leader in liquid-cooled racks. If that becomes the industry standard, their margins should naturally expand back towards the 10 or 12% range. When you're looking at online investing sites or using a Fidelity mobile app to track your IRAs, you have to ask yourself, am I an owner or a renter of this stock? Renters are the ones selling today at $31.68 because the chart looks ugly. Owners are the ones looking at the $12.7 billion in quarterly shipments and realizing that Supermicro is becoming an essential utility for the AI age. The tension here is palpable. The expectation was a smooth ride to the top. The reality is a gritty, margin-crushing battle for market share. Let's talk about the future outlook. If Supermicro can prove in the next 2 quarters that they can maintain their massive revenue growth while slowly ticking their margins back up, the stock could easily see a massive relief rally. The catalysts to watch are the launch of the next-gen NVIDIA platforms. Since Supermicro has already secured the footprint in these data centers with their aggressive pricing, they are the incumbent when it comes time for the next upgrade cycle. It is much harder for a customer to switch to a competitor like Dell or HP when their entire cooling infrastructure is already built around Supermicro's modular design. However, the risks are real. Beyond the margin issues, there's the specter of internal controls and financial reporting. We've seen some headlines over the last year about delays in filings and auditor changes. For many investors using professional-grade tools like the Interactive Brokers trading platform, these governance risks are a non-starter. They want clean books and predictable reporting. Until Supermicro can put those concerns to bed for good, there will always be a risk discount applied to the stock price. This is why you see it trading at a much lower price-to-earnings ratio than its peers in the semiconductor space. The sector momentum is also a factor. We've seen a rotation out of pure hardware and into AI software recently. Investors are looking for the next layer of the stack. But as the smart friend over coffee would tell you, you can't run software without the iron. As long as the demand for compute continues to outstrip supply, the companies that can build and ship the iron will remain relevant. Supermicro is the fastest at doing exactly that. Their manufacturing facilities in Malaysia, Taiwan, and the US are running at high capacity to meet this need. To summarize where we stand with SMCI today, the live price of $31.68 reflects a market that is deeply skeptical of the company's path to profitability. The expectation was that AI would be a high-margin gold mine for everyone involved. The reality is that the gold rush has entered a phase of brutal competition, where only the most efficient and aggressive will survive. Supermicro has chosen the path of the aggressor, sacrificing short-term gains to build a massive locked-in user base.